All right, so here we are. Now, this subject matter tonight is probably the most complicated that we'll see all this semester. But luckily, all the assignments have been set up in templates and Excel, so we can get a lot done without necessarily going through a lot of math. So let me get everything open real fast. Oh, by the way, I discovered the Zoom thing. We thought that it was corrupting the Excel files. I don't think so now. Let's see, because I think what is happening is that if you click it on, it appears that it's somehow done something to it that it shouldn't have. But I think if you download it, you'll see that at least it should be working correctly. So we have here some spreadsheets, two for Black-Scholes and two for, yeah, here we go. So now that looks like a PDF document, but if you download it, oh, holy crap. Well, you know what? The thing is, I did call them. What the hell is going on? I called them and they couldn't figure it out either. So I could have sworn maybe, all right, hold on. Oh my God, I thought that the problem was resolved. Oh, this is unbelievable. It just, no, they looked at it and they called me back and blah, blah, blah. And I said, no, we can't figure out what's going on. Okay, so I really thought they had the problem taken care of, and now I see that I was mistaken. Sorry about that. You know what I'm going to do right now? I'm going to have to email these out right now because we need them. Okay, you've got to have the spreadsheets. Otherwise, this is all, I can't believe this. Yeah, it was unbelievable. I thought I also got a reply from them. Oh, here we go. Oh, for Christ's sake. Please share the course site. Or I told them over the phone, and this is how they. I can't believe this. All right, so I guess I will be giving up on that. I will just send them all to you. Hold on one second. I mean, I was on the phone with them for at least 20 minutes, and we were both looking at it and everything, and they just were completely clueless. All right, well then, oh, this is the wrong one. No, wait a minute. Didn't I send some out once before? I could have sworn there was a couple of cases when I had to send you all a spreadsheet because it wasn't working correctly. Oh. Okay, here we go. So I'm just going to go back in and find everything we need, and I'll just send it to you right now. They obviously are too useless to get this thing fixed. All right, so there's two Black-Scholes examples. And then You have binomial option pricing examples. Yeah, it would have to be these two. Hmm. Well, it'll probably take a minute to open these up. Okay, so it refused to open up this one. All right, so with these in hand, it's going to make it a lot easier to follow along what we're doing, and especially it'll be easier to do the assignments. So let's go. The first one we're going to look at is the Black-Scholes. So basically, okay, let me open up the assignment too and remind myself what questions we had. Let's see if they're able to resist the temptation to turn this into PDF, although it shouldn't matter so much with this one. Not only that, but it won't download it. All right, I guess I'll just open it up from here. I guess I just won't even use the Brightspace is obviously useless, but anyway, I'll just go get it open for my own notes. So first you have fill-ins, which is kind of nice because you're just repeating. So basically, what you're doing is you're calculating the Black-Scholes price of an option. And so what you can do is you actually could do this with a calculator, but if you'd rather not, what you could do is just save one of these Black-Scholes examples. I'd recommend you use number 2, by the way, because it's the more general version. And what you can do is essentially just change these numbers. Let's say all the inputs, which are from this point up. Everything down from D1 down, those are calculations from the model. Okay, so your part is to fill in these, and that should give you the results you're looking for. Okay, so all right, anyway, let's go to the slides and introduce this topic. Now let's see if it's turning these into PDFs. All right, it doesn't matter. I'll just open it up. All right. Now, just bear in mind, this is a very complex topic. So what we're going to do is try to focus on the important ideas. The math, we can do that in the spreadsheets. But what we want to understand is basically how options are priced in the marketplace. And, it's a very interesting topic, but also there's an interesting history behind it. So the Black-Scholes model was actually an academic paper that was published in 1973. And believe it or not, it was rejected by 8 journals before Black and Scholes could find a publisher to take it. It ended up being published in the Journal of Political Economy, which is kind of interesting because that's not the kind of thing they normally publish. But they were the only ones who would take it. I mean, the others were just, I'm sure in retrospect, they were very, very sorry. But, that it's like it happens sometimes. By the way, I just realized something. Let me just close all this stuff down. I'm not seeing our meeting. What the hell is going on? Oh, here it is. Jesus. All right. I just want to make sure. I mean, you know how technology is. Once it starts falling apart, it's just like a cascade effect. So anyway, so the Black-Scholes model was published in 1973, and it was never meant to be anything more than an interesting result. They worked in this model, and their goal was to show how to price European call options written on stocks that do not pay any dividends. And, they had no idea that they were about to revolutionize finance. And so, to them, it was just like another academic paper. Here's this topic that nobody's really explored properly. Maybe we could do something with it, something along those lines. Well, to say the least, they were surprised by how important this turned out to be. And later on, they extended it to price other types of options. And then other researchers showed eventually how we could use the same mathematical framework to price American options. And then, from then on, there's all kinds of research showing improvements to the model. And but this was the path-breaking model that got the whole process started. Without Black-Scholes, there might not be any options trading in the United States because there wasn't any before that, or very little, because nobody really understood how to price them. So they really opened up a lot of doors here. And in fact, it was from that point on that derivatives trading really started to take off because options proved to be so useful, so powerful, so, interesting that the volume of trading went through the roof almost overnight once this paper was published. Now, just as an interesting historical side note, the Black-Scholes model itself was actually created by 3 different researchers: Fisher Black, Myron Scholes, and then Robert Merton came along after Black and Scholes started working in this paper. And he joined the team, basically. And he also came up with a lot of the most important mathematical insights that they used in their paper. And now, what happened, I've heard this story before, when it came time to publish the paper, Black and Scholes apparently said to Merton, listen, you've done as much work as we have. We'd be very happy to call it the Black-Scholes-Merton model. And he apparently said, nah, don't bother. It's not that big of a deal. Now, if you notice in Hull's book, I believe he does actually call it the Black-Scholes-Merton model because all 3 of them were so instrumental in this path-breaking work. So if you see that in there, that is the reason why. Now, this paper was published in 1973. In 1995, the Nobel Prize Committee got together and they decided that this would be the year to have a finance prize. The thing about the economics prize is that there's so many different fields of economics, and they have a tendency to rotate through them all. One year it'll be the year of international trade, and another year it's the year of labor economics, and then the next year it's econometrics. So this, in 1995, it was the year of the finance model, and they chose the Black-Scholes model. Now, by that time, actually it was 97, sorry. It was 1997. Now, by that time, unfortunately, Fisher Black had died, but Myron Scholes and Robert Merton shared the Nobel Prize in Economics because of this paper. Okay, so it took 20 plus years to catch up with them, but they did eventually win the award because it turned out to be so very important to economics and finance. And it's very rare you find an invention or a discovery that is this path-breaking, but that is exactly what happened here. Anyway, after the Black-Scholes model was published, Merton went ahead and wrote another series of papers where he explained how to increase the number of different options that we could price with this model. Fisher Black also later on himself wrote a paper in which he tried to explain how to price futures options with the model. And then, but it took other researchers to come up with the idea of how to price American style options. Okay, that was a different group, as we'll see. Their names were Cox, Ross, and Rubenstein. And I'm kind of wondering how long it'll be before the Nobel Prize Committee catches up with them, because the reality is most options at this point in time are American style, which means that in a lot of ways that is almost more important than what we have here. Now, interestingly enough, when the paper written by Cox, Ross, and Rubenstein was published, they were trying just to show in a more user-friendly way how the Black-Scholes model actually works. They were trying to break it down into discrete steps and say, here's how Black-Scholes actually works. Because the original Black-Scholes paper is very dense, very mathematical. And then it turned out that because of the way they structured their model, it is actually possible to price American options with the Cox, Ross, and Rubenstein framework. And just like with Black and Scholes, they really did not fully appreciate at the time how important this would turn out to be. So, a lot of great discoveries aren't really fully appreciated in their time. Sometimes something else has to come along before its usefulness becomes fully apparent. Let's face it, in the history of science, I guess we could call it, timing is everything, right? A great invention could come along, like Da Vinci invented a lot of things that couldn't possibly be built because it was only the 15th century. Like submarines, for example, and helicopters. Those were all his ideas, but there was no technology at the time to build them. But anyway, we've already discussed pull-call parity, so we'll see that again tonight. And then, of course, we'll introduce the binomial option pricing model, which makes it possible to price American options. Now, since all of this, as you can imagine, a lot of research has been done in this area of pricing options. And a lot of the research is dedicated towards relaxing some of the stringent assumptions that are made by these models that may not necessarily be true, which we'll discuss in a few minutes. The problem is that whenever somebody tries to do that, though, the results tend to be insanely complicated. And it gets to the point where you have to wonder if it's really worth all this extra complexity to add a relatively trivial amount of improved accuracy. So the beauty of the Black-Scholes model is that it's ultimately based on the normal distribution, which you may have run across in any stats classes you may have taken along the way. And the normal distribution does a good job explaining the returns to stock prices, but it's not perfect. There are issues with it. Okay, and we'll discuss that too. So anyway, here comes the Black-Scholes model. So it was published in 1973 after being rejected 8 times, as I said. And originally they wanted to keep it simple by only using it to price European call options on non-dividend paying stocks. Now, at this point in time, the Chicago Board Options Exchange actually was open for business, but they only offered something like 8 options. I mean, that shows you how little trading there really was at the time in options. And within a matter of just a few years, the volume of trading was just absolutely astronomical because everybody recognized pretty quickly how important this turned out to be. Now, let me just briefly show you some of the assumptions that we're basing our model on and why there can be issues here. So we start by assuming that the returns to the asset in the case of this model, the stocks that we're trying to price are assumed to be normal. Okay, now the volatility, and this proves to be the biggest sticking point with the model. Volatility is assumed to be a constant, at least during the lifetime of the option. So That's the part that we have the most trouble with. The reality is volatilities can change every day. And so that is one of the big holdups to this model, one of the things that sort of reduces its accuracy. We're also assuming that the risk-free rate of interest is a constant during the life of the option. That is not a terrible assumption. Interest rates don't change that much within the lifetime of an option, which is typically 6 months, maybe a year at the most. So now what I've done here is I've tried to draw a picture of why the normal distribution is not a perfect illustration of the returns to stocks. That black curve is the normal or bell-shaped curve. The red is a reflection of what returns actually look like. So you can see there's two problems. Number one, the returns, the red returns, the actual returns are more spread out than the normal distribution. So in other words, there's more extreme outcomes with actual stocks than there would be if their returns were strictly speaking normal. And secondly, if you notice, there's a slight bias in favor of negative returns versus positive returns. So in technical terminology, we say that the returns to these stocks are negatively skewed, meaning there's an imbalance here from the low end to the upper end. There's more negative returns than there should be, and there's fewer positive returns than there would be with the normal distribution. So those are the two ways in which returns are not, strictly speaking, normal. So that does detract a bit from the model, but it's not that far off. Let's say this is not a terrible assumption. It's just not maybe perfect. So the volatilities, like I said, are the real issue. We're assuming that the volatilities are constant during the lifetime of an option. We also are assuming that the volatilities are constant for all options written on the same stock. In other words, if I'm looking at Apple stock, that the volatility is the same for all the options written on it, regardless of their maturity and regardless of their strike price. And we know that, as we'll see, that that's not strictly speaking true. In fact, we often see these diagrams, which we could look up, and I guess we can find some examples on the internet. But if you were to take volatilities and try to map them against the maturities of these options, so there's if I lined up a bunch of Apple options, and these are all options that have the same strike price but different times to maturity, the volatility pattern could be upward sloping, could be downward sloping, or it could be flat, which is what Black and Scholes are assuming. The interesting one is the relationship between the volatility and the strike price. According to the Black-Scholes model, this should be a constant. But in reality, with stock options at least, it tends to look more like this. In other words, if you notice, there's a pattern to it. And so this curve here is sometimes known as the skew of volatility. So in other words, Black-Scholes is assuming the straight line. The one below it is actually what we're seeing in the real world, at least with stock options. This pattern can be different with other types of options. So what some traders do is they'll make little tweaks to the model. They'll try to adjust it for what they believe is a better description of volatility, and then use that to come up with Black-Scholes prices. There are ways this could be done. You can take the Black-Scholes predictions and make little changes to allow for differences in volatility across the different strikes. And so whether that's a success or not is a very interesting question, because this is usually proprietary research that's generating these results. The individual banks and brokerage houses, if they stumble onto a good model or a good way of adjusting Black-Scholes prices, they're going to keep that to themselves because they can make a lot of money by exploiting this information. So we may never find out how well these alternative measures actually work, but you never know. We might find out eventually when some of these people start retiring. But anyway, so this is where really Black-Scholes has its biggest problems. Its assumptions are false compared to what we're seeing in the real world. Now, having said that, it turns out, interestingly enough, that these assumptions were more accurate in 1973 when Black-Scholes was first published. So it's not like they missed the boat, but circumstances have changed, market conditions have changed. And so now you see this skew of volatility, which we didn't really see in the 70s. So they were probably, the accuracy was higher at the time they were publishing this paper. And since then, these skews have started to develop. And so that for that reason, the Black-Scholes model does have some problems. So anyway, what else? Now, I'm going to show you a picture of the formula that we'll be using to price our European call options. And there's some components of it that are very straightforward and some components that are a little bit more involved. So that's why we have this wonderful spreadsheet here. You can start with Black-Scholes number 1. And I've written in a bunch of stuff by hand, but you can see that our example is right here. And right there is the call price that we were calculating with the Black-Scholes model. So in this example, first, here's the formula. And, oh, there it is. Okay. So, like I said, the S is simply the stock price, X is the strike price, and E is that constant that we've seen before. It's approximately equal to 2.71828. R is the risk-free rate of interest, and T is the time until the maturity date of this option. The ND1 and ND2, those are basically there to simplify the model. They represent something else. Okay, so in other words, D1, show you in the next slide, is this expression right here. This is D1. And you can see this one does actually include the volatility term. Sigma, the Greek letter sigma, is our measure of volatility. When it's squared, instead of calling it volatility, we call it variance. Down here in the denominator, we do have sigma times the square root of t. That sigma without the square is the volatility or standard deviation of the stock's returns. And then D2 is just D1 with a constant subtracted from it. But the tricky part is not the D1 and the D2, but that N. If you see in the formula, N. What does this N mean? Well, the N is a function of some kind. So basically what we're considering here is if you look at this graph, this curve is the normal distribution. What we're trying to find out is under the normal curve, actually, let me show you this one instead. Under the normal curve, what is the probability of being less than or equal to this D1 term? So that shaded region is the probability that we're looking for. And so that's what ND1 represents. Whatever D1 is, it's some constant. N of D1 is simply the probability that a random variable, a normal random variable, is less than or equal to D1. And that we can easily figure out in Excel. Think of it as the probability that a normal random variable is less than or equal to D1. Okay. Now, I'll show you in a bit how we calculate that in Excel. So then we do the same thing for ND2. So why don't we come back here and look at these numbers? Now, this example has a stock price. We have a 1-year call option on XYZ stock, which pays no dividends. The strike is 50. The 1-year risk-free rate is 2%, and the stock is currently selling for $52. The volatility, assume that we've calculated this somehow, is 30% on an annual basis. Okay, so we're going to use all this data to come up with a Black-Scholes price for this call option. Okay, so here's the data we need. stock price is 52, the strike is 50, so it's $2 in the money, you notice. Risk-free rate is 2%, the sigma is 30% per year, and T is 1. Now, over here is an illustration of how D1 is actually calculated. Okay, and so the formula is here, and it is a scary looking formula. Look at that. Oh my God. So this is why we have a template, by the way, because imagine how easy it would be to make a typo here. Way too easy. Okay. So this is D1. D2 is just D1 minus sigma square root of T, which you can see here in this box is illustrated. The calculation is D1 minus sigma times square root of T. So those are the D's. Now the N's, these are the normal probabilities associated with these D's. In Excel, we can come up with these by typing in the command norm.s.dis, which stands for standard normal distribution. And the B7 is our D1. The 1 is a required value. You have to give it a 1 there. Okay, there are other options, but they're not the ones we want. So in other words, you would put norm.s.dist. First, give it the value of what you're looking for, which in this case is D1, and then a 1, and you'll get your probability. In fact, I've illustrated it down here. This graph represents this so-called standard normal distribution. And if you notice, since D1 is 0.3474, that shaded region is the probability of being at or below that level. And that turned out to be 0.6359. So where's that coming from? The Excel is calculating the area under that curve from 0.3474 all the way down to negative infinity. So in other words, 63.59% of the area under this curve is to the left of that 0.3474. Now ND2, it's the same function, only you're applying it to D2 instead of D1, norm.s.dist. Now we can tie this all together. Here's the call price. Now, that is this. Okay, so if you look at the formula, you'll see what I've done. You've got B1, which is S, times B9, which is ND1, minus X, which is in B2. E, by the way, E in this Excel is EXP. The exponent is minus B3, which is R, B5, which is T, and all of that is multiplied by ND2, which you find in cell B10. Okay, so this is how it's done. So that is the Black-Scholes model, and this is the price that it suggests for this particular option. Now, here's an interesting thing to think about. The option has an intrinsic value of S minus X, the maximum of S minus X or 0. In other words, if I could exercise this right now, I would get a payoff of $2. So that's sometimes known as the option's intrinsic value. There it is. The option's intrinsic value is $2, the difference between S and X. This is the minimum price at which it can sell in the market to avoid an arbitrage. Okay, so in other words, if you could buy this option for less than $2, then you would buy the option and you would deliver the stock and collect the money. Let's say, how would you work that out? Hold on. Oh, N of D1. It's not D1 or D2, it's N of D1, N of D2. I'll put this at the bottom here. ND1 can be interpreted as the sensitivity of the call price to a change in the stock price. So here, since ND1 is 0.63 something, 63.59. So this means that if the stock price rises by $1, the call price will rise by approximately 63.59 cents. Okay, now you notice the keyword there is approximate. If the change in the stock price is larger, the accuracy of this estimate will worsen. Okay, so in other words, if the price goes up $1, you can tell, I mean, it'll be pretty close to 63.59 cents. If the price goes up $10, then it should, the option should go up by about $6.35.9 cents, but then that approximation is less accurate. So in fact, I'll tell you what, here's a fun way of testing this. What I'm going to do is over here, make a note that when S is 52, the call is 7.633. If I raise the stock price to 53, let's see what happens to the call price. It'll automatically update itself to 8.2808. So the difference between the two now we're keeping our fingers crossed. It should be 63 point something cents. It's about 64. So it's not perfect, but it's an approximation to how much this option price should change when the stock price goes up or down by $1. Now, ND2 refers to, and we have to interpret this very carefully. The risk neutral, which we will discuss later on tonight, the risk neutral probability that the option will finish in the money. Now that is actually a derivative of the Black-Scholes price. Okay, so if you apply calculus to the Black-Scholes model, you'll see that it works out approximately right. We can think of it as roughly the probability that it'll finish in the money. And you can see here, that's just slightly over 50%. Because it's not that far into the money right now, and there's still a year to go. But what I do want to mention here is that if you notice, the intrinsic value is $2. And we know that that is the minimum price at which you can sell to avoid an arbitrage. Why is it so expensive then? Why is it selling for 7.633 when the intrinsic value is 2? Well, what's happening is that the rest of that is what we call the time value of the option. Okay, so if you notice, this black line here is the payout profile. That's where the intrinsic values are determined. The red is the market price a year before the maturity date. So for the stock price of $52, if you read up to the black line, you'll see that the intrinsic value is $2, but the market price is 7.633. So the difference between the two, which is $5.63.3, we call that the time value of the option. And that basically is what you're paying for is the possibility that the stock price could continue to rise and that your profits will go up as well. So that's what you're really paying for, the opportunity to earn more money in the coming year. So while it sounds like a big discrepancy, as we get closer to the maturity date, the time value will automatically shrink And on the actual expiration date, the time value will be 0 because the option's price will exactly match the payoff or intrinsic value. All right, so that's what the time value means. And we'll see more of this next week, by the way, when we look at the Greeks, the risk measures, where one of them refers to what happens to the value of the option due to the passage of time. Okay, so just be aware that when you're buying an option, some of what you're paying for is the time value. The rest is what you're paying. You're paying for the intrinsic value, but you're also paying for the time value. So that's why the spread between the actual price and the intrinsic value can be so high. In fact, when you stop and think about it, all options that are out of the money, all the value of the option is coming from that time value. So like if you look at this chart or graph, if let's say that the stock price is 48, the intrinsic value is 0, and yet you can see from this graph, the option is selling for more than $2. 100% of that has to be time value because the intrinsic value is 0. And you'll never see an option in the marketplace trading for 0. Even the ones that are deeply out of the money still are worth at least a penny. Okay, there's always some chance that the option will finish in the money. So anyway, so this is our first Black-Scholes example. And so you can see, while yes, it's a complicated model, the reason why it's so popular with traders is because you can pop these numbers into a calculator and have your price instantaneously. So anyway, now if you notice there's a P here, 2 P's actually. Remember last week we talked about put-call parity. Put-call parity is that relationship between European calls and puts, which you must hold to avoid an arbitrage. So how does this work now? Well, we saw that there's a few different versions of it, depending on what kind of cash flows are being paid by the asset to the owner. So here it is. This is the basic version. This is the one that assumes no cash flows are being paid to the owner. And so this is our put-call parity condition. This does require us to know the European call price. I'll show you in a minute another alternative to it, which does not require that information. You're taking the call price that you just discovered, adding to it the present value of the strike, and then subtracting the stock price. So here, the put is worth 465. Which is, there's some rounding involved. Here, it's a more exact answer because it's Excel. Here's the formula, and this is how it was done algebraically. All we had to do was take this call price, which is B11, then we add to that, now B2 is X, E to the minus RT minus S. And all that gives you the put price that's implied by put-call parity. Now, here is an actual formula that we could use if we don't already know the European call price. You can see it's a bit messier. And in fact, it requires n of negative D1 and n of negative D2, which I actually did put here for our convenience. But, you can decide for yourself which one of these you prefer. But if you have the call price, you might as well use put-call parity. This is a bit of a mess. But if you do plug in the numbers, you'll see that you get the exact same result. Okay. So you already have the ability to do any European call or put prices when the underlying asset does not provide any cash flows to the owner. You also understand the difference between the time value of an option and its intrinsic value. Okay. So already we've covered kind of a lot. Now, of course, going on behind the scenes is some scary mathematics. In fact, a lot of this is actually borrowed from physics. And in fact, Merton introduced them to this new concept called stochastic calculus, which is sort of a an extension of traditional calculus to random variables. It was invented by a Japanese mathematician named Ito. And he eventually won the equivalent of the Nobel Prize in Math. I think it's called the Fields Medal. And he was very old. I mean, invented this in the 50s. And so nobody really knew what to do with it. And Merton was the one who apparently came up with the idea that this framework could be built on the so-called stochastic calculus, which proved to be a good idea because if not, they would not have been able to extend this model to all the other different directions that they did. So it's a good thing Merton came along when he did. Otherwise, we might never have heard of Black-Scholes. So again, you never know what's going to happen in the history of science. A lot of discoveries are made by accident. People have to be in the right place at the right time. So you never know. And speaking of being in the wrong place at the wrong time, later on, researchers discovered something very interesting. There was a graduate student at the Sorbonne. Let me see if I can find this gentleman's name. Poor Lewis. Now, Lewis was at the Sorbonne in the very turn of the 20th century. Yeah, there it is, unappreciated revolutionary. And what was sad about him is that he was a mathematician, and it turns out he wrote his doctoral dissertation about what we're talking about now, not the Black-Scholes model, but the stochastic math that went on behind the scenes and is used in the Black-Scholes model. And so because he wrote this in French and was never translated into English, his dissertation sat on the shelves in the Sorbonne gathering dust for, well, maybe not a full 100 years, but awfully close to that. And nobody knew until I think it was the economist Paul Samuelson who stumbled onto this. He said, listen, Bachelard actually came up with a lot of these ideas in 1905, or actually in 1900, and somehow nobody ever found out about it. And he spent the rest of his life frantically looking around for an academic job, when in reality, he should have been very famous. He should have had his pick of any university job he wanted, but instead it somehow was neglected. And so nobody ever knew during his lifetime what he had accomplished. Yeah, so I mean, like they're saying here, his results were not quite as rigorous as what we're used to seeing now, but he did come up with some of these ideas well before anybody else knew anything about it. So sadly enough, Louis never really got the recognition he deserved. But he did, as we now know, make major contributions to the mathematics of option pricing theory. Yeah, oh well. But anyway, so now, oh, so here's, we've already seen this. This is the proof of why put call parity works, or why it is an arbitrage-free relationship. So we don't need to go through this again. Basically, what you're doing is you're setting up two portfolios, put plus the stock. Down here, we have the call plus a treasury bill, whose face value is X and matures at time T. And what we're going to see is that no matter what happens to the stock price in the future, the two portfolios will always have the same value. In this scenario, they'll both be worth X dollars. In this scenario, they're both worth ST dollars, which means the stock price at that time. So that implies that this, oops, the price of portfolio A and B must be equal. Otherwise, there'll be an arbitrage. You buy the cheaper one, sell the more expensive one. You put money in your pocket, no risk at all. Oh no, I missed the message. What did, oh, what were you asking? 13 minutes ago, what did you want to know? Sorry.
what was the question again? I can't see my chat.
Oh, it says maybe because of volatility, and I'm not sure what you're referring to, and I didn't
Oh,
see it.
no, it's just that when you were talking about when the stock price rises higher, the estimate is more inaccurate.
That's right. Well,
I
no,
thought maybe because
no,
volatility was rising quickly or something.
no, you know what it is? It's to do with the fact that the Black-Scholes model is not linear. So when you change one variable, the impact on another variable is not necessarily going to be proportionate. Let's see. Trying to think of it. There's a graph that will let us illustrate this. Oh, I know what the problem is. If you look at this graph, let me just draw it again. The payoff profile and the market price. I'll use another color. Okay, well, I didn't expect it to be thick purple, but it'll do the job. So there's your payoff profile, but here's your market price. So in order for you to move from, let's say, here, let's say from here to here, you're essentially, when you, the N of D1, what you're actually doing is you're drawing a straight line. And what you're basically saying is that the line predicts that with a given change in the stock price, the option price should go from here, let's say, to here, because it's a linear measure. Whereas in reality, this is not a linear measure. So you can see that there's some inaccuracy there. And as we get further and further away from the original point, the inaccuracy continues to increase. Okay, so in other words, when we use ND1 to estimate this options price, we are using what's a linear measure, when in reality, the option price is not linear, or at least not with respect to S. So that's why it's more inaccurate with large changes in the stock price. Let's say this is a $10 change. This is 50 and this is 60. Whereas here it only went up by, let's say, $5. And so it's more accurate when the price of the stock goes up by 5 than by 10. And if we keep pushing it, oops, like if we try this with $20, you can see the approximation error will continue to grow. So with these kinds of measures, these sensitivity measures, it's understood that they typically are only accurate within a very short frame. Although there's well, we'll see when we get to the Greeks next week, how to correct for this to a certain degree, but that's why the ND1 is not going to give us a perfect forecast for what will happen to the options price when S changes. All right, does that make any sense?
Yes, it does. Thank you for drawing that out.
Okay.
Thanks.
Sure. And remember, that's the market price, and this is the payoff. So yeah, it has to do with the fact that this market price curve is not a straight line. That's really what's driving this. Okay, all right. So anyway, so because these two portfolios must have the same price today, in order to avoid an arbitrage, we can set these equal to each other and rearrange it algebraically, and we end up with this put-call parity condition. And again, if it's violated, we buy whatever is too cheap, we sell whatever is too expensive, we put the difference in our pockets, and as we've seen on the maturity date of the options, the cash flows will exactly offset each other, and we'll be left with no exposure, but somehow we put money in our pocket today. It shouldn't work that way. You shouldn't be able to make money by not taking any risks, and yet that's exactly what happened. So that's our put call parity condition. Now, given that many assets out there do pay cash flows to the owner, we have, for example, currencies. The owner of a currency can earn the foreign rate of interest. We have stock indexes. Like, imagine you have an option not on the stock, but on the S&P 500. The S&P 500 does have a dividend yield, okay, because all those stocks at any given time are providing dividends to the owners. So it became pretty clear to Merton, at least, after Black-Scholes came out, within the next year, he published a paper where he said, in order to extend this model to price other types of European options, we can make a fairly simple tweak to it. And so what is that tweak? Here's what we're going to do. We're going to introduce this letter Q, and think of Q as the continuously compounded yield, we'll call it. I'll put that in quotes because we don't always, sometimes we just call it the return to the asset. Okay. So in other words, just as an example, if S is the British pound, then Q is the British rate of interest. Because the owner of that currency can earn the British, actually I should say, yeah, the British rate of interest, that's fine. So by holding a call option, instead of owning the currency, you're sacrificing the opportunity to earn that British rate of interest. So we have to reduce the value of the call to take that into account. That reduces the attractiveness of the call. So what you're basically doing here, when you multiply this term, because the exponent is negative, this term is guaranteed to be less than 1. And so therefore, S e to the QT, times QT is less than S, just plain S. So that implies that the call price is going to be lower as a result of this. Okay. So if we had some currency, let's say in a country that has a 0 interest rate, like possibly Japan, then this term would just go to 1 and we'd end up with S. But that's not normally the case. If S is the S&P 500, then Q would be the dividend yield for the entire S&P 500. Now, most of the time, we can get away with the assumption of continuous compounding. It's not perfect, but I would just remind you that continuous compounding, let's just get out a document here. We have 2 types of compounding conventions. Discrete compounding refers to or results when the number of compounding periods per year is finite. For example, monthly, quarterly, daily, etc., are all considered examples of discrete compounding. Whereas continuous compounding is the limiting case of this. When the number of compounding periods per year is literally infinite. Now, it seems hard to believe, but, and I guess maybe we don't have time to go through a full example of this, but daily compounding and continuous compounding give very similar results. In fact, just by a ridiculous coincidence, I was doing an example with one of my classes this morning. And it turns out that when the rate of interest is 4%, $1,000 deposit grows to with daily compounding. And with continuous compounding. So in other words, that's how little difference it really made. So what that means then is that while holding British pounds will give you in practice a rate of return that's compounded on a daily basis, because that's what banks do. They pay us on a daily basis. By assuming that it's continuous compounding, you're not really losing a whole lot of accuracy. And it's just, you'll see all these derivatives models, we always use continuous compounding because it's simpler and it avoids certain types of biases. So, and in fact, if you look at Hull's book, he takes it kind of to an extreme level. He almost never uses anything except continuous compounding, even in cases where it's clearly not what's happening in the real world. He loves continuous compounding. Well, one of the great things about it is that it's easy to take the results from some kind of investment and figure out what kind of return we got over a given interval. Okay, so it has a lot of advantages. Now, e to the minus qt, by the way, means we're calculating the present value of s. Okay, I don't want to forget about that. So in other words, again, assuming that s is the British pound, this expression gives us the present value of s pounds received at time t with a rate of q. Okay, so that's what that means. It's the present value. Now, the D2, the D1 has to be adjusted for this as well. Okay, so there's only two changes. We add this part, which wasn't there before, to adjust for the fact that the call is less expensive when the underlying asset provides a cash flow. And then algebraically, it turns out that we also have to tweak this expression. And that's it. That's literally all you have to do. And this is now sometimes known as Merton's model, because he went out and he published this on his own. I think Hull's book calls it that too. And so it's understood. This is think of it as extended Black-Scholes. It's like Black-Scholes opened where we opened the doors to other assets besides non-dividend paying stocks. They still have to be European options, but now suddenly we can have any kinds of underlying assets you could imagine, like currencies and bonds and even non-financial assets. As long as we can calculate the rate of return to the owner, we can price an option on it. So now this example is what I've labeled in my spreadsheets example number 2. Now, what's different with examples 2 and 1 is that example 1 is the original Black-Scholes model. There's no Q in there. There's nothing. We're assuming this is a stock that provides no cash flows. So if you look at the two side by side, what I did was I used this blank space here to introduce Q. Okay, that wasn't there before. You can see it. It was missing. So now, then I had to make two adjustments. I had to use the new definition of Q, which include, D1. This formula now includes the negative Q. And the actual model itself right here requires this SE to the minus QT. So I would recommend that when you do any kind of option pricing results, you use this one, because if you, let's say you have a call option on a stock that does not provide any dividends, you can still use this model by just setting Q equal to 0. Okay, so in other words, this is the more general model. This is the one you should be using. This one only is restricted to cases with no cash flows. Here, you can go with assets that do have cash flows and those that do not by simply changing the Q. No cash flows simply means Q is 0. Okay. So yes, I mentioned here, this is often referred to as Merton's model because Robert Merton created this about a year after Black-Scholes came out. He was like so pumped up, I guess, he decided to go up and publish some more papers. I actually met somebody once who got their MBA from Harvard, and he was actually in one of Merton's classes. Merton taught at Harvard. I don't know if he's still there. He'd be very old by now. I know that Fisher Black is no longer with us. Myron Scholes, I think, is still alive. He was at Stanford. Let's find out. What the heck? Is Myron Scholes still alive? I guess so. God, hell, he must be pushing 90 now. No, he's only about 82. I'm surprised. Yeah, because in 1973, he was only like 32 years old. Wow. And then Robert Merton. No, oh my God. Oh no, yes, that's him. Oh, I had no idea. He made it to 92. Oh, but he was born in 1910. My God, he was already in his 60s when he helped these guys with their paper. But anyway, the funny thing is, oh wait, no. That's this one on the right is not the right guy. Or is it? Wait a minute, I'm confused. This one says that he's a sociologist, and this one says he's an economist. So, all right. Well, anyway, yeah, that must be okay. So here's the example. If a stock's selling for $30, so we got that in here. The strike price is 28. So once again, the intrinsic value is $2. It does have a continuously compounded yield of 3%. Now, realistically, this is where the approximation might break down a bit because we know that dividends are paid out on a quarterly basis, but it's possible to convert a quarterly payment into a continuously compounded yield without losing too much accuracy. Okay, in other words, what we're essentially doing is pretending that the dividend a little bit is paid out every instant in time rather than 4 times a year. So we'll let this slide. We'll call it a continuous yield of 3%. The risk-free rate is 5%. And this time it's only a 6-month option. T is a half of the year. So you plug this in. Now you notice this time, the intrinsic value is 2. The call is only selling for $3 and 10 cents. Wait a minute. Hold on. Okay. Oh no, something's wrong. There might be a typo in here somewhere. Oh, I think I know what happened. What? Oh, you know what this is? All right. You have to change this. Sorry. You change it back to 20. I must have been fooling around with it. Yeah, it was supposed to be 20. So that there it is, 296. So this time there isn't nearly as much time value, but you can see why, because it's only 6 months to maturity instead of a full year. And that has a lot to do with it. So there's still time value, just not nearly as much as we had in our last example. Then now remember, we did mention this last time, there's a different version of put-call parity under these conditions. The S is again being replaced with SC to the minus QT. So this is the new formula for the put-call parity condition. But we also can use this approach where this formula doesn't require us to know the call price, but it's a lot messier. So this first one is the put-call parity condition. The second one is this model right here. They both have to give us the same result because what you're essentially doing here is plugging in the put-call parity condition into Black-Scholes to come up with that number. And you notice both times the put is cheaper than the call because the put is actually out of the money and the call is in the money. Now, by the way, if you want to do some experiments and change the numbers and see what happens, you can certainly feel free to do so. But what I noticed that I think I know why that strange volatility number was here. Because what we might as well discuss right now is this concept of implied volatility. I see that I have it here in sheet 1. So what this is all about is this. Volatility is the only parameter of this model that is not directly observable in the market. It is implied by market prices. You can't actually look at volatility. It's not like a rate of interest where there are quotes in the Wall Street Journal or time to maturity. This is something that is implied by market prices. So what you can do is this curve here represents the relationship between a call's price and its volatility. And you can see that as the volatility rises, the call price rises, but not in a linear fashion. In fact, as this volatility goes up, the price increase in the call keeps shrinking. The curve is flattening out. So the example you're seeing here is one where I said, listen, according to Black-Scholes, if the volatility is 20%, the market price should be 2.9682. But what if we look in the Wall Street Journal and we see that the market price is actually 310? That means that the volatility assumption is wrong. So how would one figure out what is the appropriate volatility then? Good question. So you know what I'm going to do here? I'm going to copy this into a new sheet. I don't want to mess with what we have. Uh-oh, what happened? Oh, I know what I was supposed to do. Hold on. I'm going to copy the whole thing. What I'm going to do is this. I'm going to say, listen, how did I do this? All right, in order to do this properly, what we're going to have to do is put another call in here. And let's just say that we observe that the actual price is 310. Which means that the 20% volatility is too low. What we're going to do here is calculate the so-called implied volatility, which means the volatility that is consistent with a market price of 310. Whatever it is, you can see that it has to be higher than 20%. So what you're going to do is introduce a very cool feature of Excel called Solver. And what I'm going to do is say to Solver, listen, It's on, it should be on your data tab. And Solver is an optimization package. And what I'm going to say to it is, listen, Solver, I want you to set this price equal to a value of 310 by changing the volatility until you get to the right level. Okay, so when you run it, it'll say, ah, I see what you mean. Oh, it doesn't seem to have done anything. Why not? Oh, there it is. Sorry, it's there. I didn't see it. 310. And if you notice, it changed the price to 310. And it did that by changing the volatility to about 21.9%. So what that means then is that if the market price is $3.10, that implies that the volatility of this stock must be 21.9%. We call that the implied volatility. That is the volatility that is implied by the Black-Scholes model. Okay, so implied volatility is proved to be very important because the volatilities that we assume for Black-Scholes are based on historical data. We think of them as backwards looking, meaning they're based on past market conditions. The implied volatility is what we're seeing right now in the market. And we call that a forward-looking measure because it means that this is what's going on in the market now. Now, the VIX that I showed you last time, we can sort of discuss it a little more in more detail. The VIX basically represents the implied volatilities of Standard & Poor's 100 stock indexes, I believe. Let me just double check that. Yeah, I know it says the market's expectations, but it's calculated as the implied vols. Oh no, it is S&P 500. Okay. They take a look at the S&P 500 calls and puts, and I don't know how they do the weighting, but they're looking at the call and the put for the next 30 days. Whatever number they come up with is the VIX. Okay, so think of it as the implied volatility of an average, I guess, of the call and the put price. So we saw that last time. It shows us that volatilities tend to rise when the economy is in trouble, and they tend to be very low when things are going well. So it's kind of a measure of market turmoil. And there do exist options written on the VIX. It's trading on the CBOE. Where the underlying asset is considered to be the VIX. Okay. And it says here they trade as European style options. All right, very good. So this is implied volatility. Now, you can do whatever you want with it. I could try a lower price, like 250. Let's see what happens if I ask for 250. Now, I don't have to change anything. All the information is still kept in the dialog box there. And that's strange. Last time it updated itself, this time it didn't. Why not? Not. It's B11. Oh, because I had to manually. Okay, sorry. That's my fault. It should work now. Okay, yes. So what it's saying is that in order to get the call price to 250, you need to lower the volatility to 12.5%. So that would be considered the implied volatility of this option. So 12.5% corresponds to price of 250. And this is what we mean by implied volatility. Now, if you notice, Solver is actually an optimization package. There isn't an actual formula that will let us do this directly. What's happening is Solver is trying different values of the volatility until it finds the one that gives a Black-Scholes price of, in this case, 250. So it can take a while to find the right result because it's not a formula. It is, we're using numerical methods to identify the correct value. All right. Now, what about American options? First of all, how are they different? Well, we know that American options can't be priced with Black-Scholes. Now, the reason for that is because it's not possible for us to consider the times when it would make sense to exercise the option early. I mean, that's the whole point of the American option. This is what you're paying for, the right to exercise it early. So the way the Black-Scholes model is structured, what it's basically doing is it's not really even considering the intermediate stages. What you're saying here is that here you have, oh, Jesus. Here's the stock price. And here's time. And so what's happening is that you're creating on the maturity date of this option. The Black-Scholes model is creating a probability distribution, the normal distribution. And basically what it's showing you is the center of that distribution. Oh, Solver, yes. Oh, by the way, I almost forgot to mention it. If you've never used Solver before, you have to install it. Let me show you how that's done on a PC. On a Mac, it has its own menu. It's on one of the menus. But for the PC, here's what you have to do. If you can't find it on your data tab, it means you've never used it before. And so you're going to go to File, Option, wait a minute. Options, it's way down here somewhere. Options is what you're looking for. How interesting. Options. Then you go to add-ins, because that's what this is. It's an add-in. Okay, it's not part of Excel. Just hit the go button. And then you see this little dialog box. Just click on Solver. And if you want, Analysis Toolpak is this group of statistical routines that it can do as well. You might want to use that one too. But at least click on the Solver button, and when you hit OK, it should appear under your data tab. Okay. So let me show you again what I did to come up with the implied volatility when the price is 250. Okay, I don't know what the hell is going on here. So I put B11, the objective function. That's the price that I want. Now I'm not going to maximize or minimize it. I'm going to ask it to be a value of 250. And it needs to know what cells it should change, and that would be the volatility or sigma. That's B4. That's the one that will keep changing until the market price of this option, 250, matches the Black-Scholes price. Okay, so if you hit solve, it will make the changes for you, although it might take a while because it is searching through. It's essentially recalculating the Black-Scholes model many, many times to find the right result. Okay, so did you find it?
Yes, Yes, I did. It
Okay.
was pretty easy. Thank you.
Yeah. Oh, you're welcome. It's one of those things that everyone should know about. I mean, even if you never use it, it's good to know that it's there. You can use it for so many different things. It's an amazing tool, very powerful. And it's a lot more flexible than it looks at first glance. You know, there's a lot of things you can do with it, but it's not uncommon to use it for volatility studies because it's volatility is not something we can calculate directly. We have to resort to these techniques. All right. So with the American options, we know that they can be exercised. My diagram, yes. So what you're basically seeing with the Black-Scholes is we take the current stock price, it's generating a path of some kind for the stock price, and it's saying on the maturity date, the price will be at the center of this probability distribution, and we use that to come up with the option price. So in other words, at no point in the middle, you have the opportunity to stop and say, well, should we exercise the option or not? Okay, it can't be done. No matter how people try, it can't be done. Now, there do exist approximation formulas that you can get. In fact, let me show you. If you want to look into this more, there's a book. It's been around forever, but it's really good. There it is. This book, I don't know why they never updated it, but it's essentially an encyclopedia of option pricing formulas. In other words, what they've done is they've created a lot of different approximations to different kinds of option prices, like American style and exotic options, so that you can actually implement these models without the binomial model. Depending on how much inaccuracy you're willing to put up with, they might be good enough for what you need to do. Now, it looks like I can't actually open up the table of contents. I own this book, as you can see, and it's got everything you could possibly want to know. There's a formula for everything. I don't know how accurate they are, but this guy is well known in the field. And so if you want a formula, you can have it. Okay, and that includes American options, by the way. Oh, here we are. Here's some of them. Like if you want to look at interest rate derivatives or volatility and correlation, whatever. The point of it is that these are all formulas that will give us at least a good approximation to the true values of these options without having to mess around with numerical methods like the binomial option pricing model. And, look at this, it comes with the CD-ROM, but it has examples in VBA, which VBA is, by the way, the programming language that's built into Excel. If you've never stumbled across it, I'll show you where to find it. Right? Let's see. I don't have any examples right in front of me. But what you need for that is you have to go to your ribbon and make sure it has this tab developer shown. So to show this, you'd have to go back to options. And then this time, don't ask for the add-ins. Go to the ribbon, customize the ribbon, and make sure that the box for developer is checked. And then what you're going to see is Visual Basic, and it's a programming language. You're going to create modules, they're called. And then you're going to write a bunch of code. Just commands. And when you're done, you can execute it. And then you can then get whatever results you're looking for. So this book I was just showing you, all of the code, all the examples are written in VBA code. So You could literally copy them into your Excel and run them and see how they look if you felt so inclined. So I don't know if you knew this was here, but yes, Excel has its own language called VBA. And, it's been around forever. It's getting a little long in the tooth, but it works pretty well. And a lot of people in Wall Street still use it because it's part of Excel. And it's easy to read the code. Anyway, so 1976, Cox, Russell, Rubenstein come up with this paper. And again, the whole idea here was they were trying to make it easier for people to understand what Black-Scholes was actually doing. Now, what they did is they created a model where they show you how the stock price evolves over time, according to the Black-Scholes assumptions, and what that implies about the prices of any option written on that stock. So, so here's a sketch of what you're actually doing. If you notice, the stock starts at 100 at time t equals 0, which is today, and then going forward one time step, which could be any length of time. According to this model, it can either go up to 105 or down to 95. That's it. And then one time step later, if we're at 105, it can continue to go up to 110 or back down to 100. If we were at 95, it can go up to 100 or possibly back down or down to 90. So as time elapses, we're creating this lattice or tree where for each of these points or nodes, the stock price can either go up or down, and that's it. And that's where the name binomial comes from. So we're creating this tree based on the stock properties of the stock price, including the volatility, which we'll see how that works in a minute. The volatility is explicitly considered in this model. And also, although it's not obvious, it turns out that this whole setup is based on the assumption of normality. Okay, so with this stock tree in place, we can now calculate what the call option would be worth on each of these nodes. Okay, so every one of these nodes gives us an opportunity to exercise the option early. And that's why it's well suited for American style options. And by the way, this model is designed to make sure that it also gives you the correct Black-Scholes prices for European options. Otherwise, it wouldn't be much of a model. It has to replicate Black-Scholes, and then you can have confidence that whatever American option prices you get must be correct. Okay, so you can use this model to confirm Black-Scholes prices. And once you're confident that it's working correctly, you can then go ahead and use it for American style options. Now, it does. Now, by the way, if you only are going to have two time steps like this, then the price of them on this tree could be different than Black-Scholes. But if you have enough time steps, the two will be the same or very close to each other, because they are, after all, following the same statistical assumptions. So the question is, how do we take these stock prices and convert them into call prices? Okay, so let's see how this works. Oh, you know what I just realized? Unfortunately, it looks like in this chapter, I'm using K instead of X for the strike price. It's kind of awkward because half the options books in the market use X and half of them use K. Hull, I think, uses K. So just be aware that if you see K in these slides, it means the same thing as X. I don't remember how this happened, but one day I'll straighten out these notes and make them all consistent. But we're going to, I think, going forward in this chapter, we're going to see K instead of X. So don't be confused. Anyway. We're going to introduce some terms. Now, S will be the stock price, we'll let K be the strike. Now, U is the size of an upward movement by the stock. Now, when I say upward, I mean the current value of the stock will be multiplied by U when it goes up. If it goes down, we're going to multiply the current size by D. Right? So it's always the same. It's like, let's say U is 1.3. That means going up is a 30% increase. D would be the opposite. Now, G and 1 minus G, since there's only two ways that the stock can go up and down, there's only two probabilities. G means going up. 1 minus G, therefore, must mean going down. Okay, so those are the terms we'll use. All right. So now let's start to build our tree. So here's the notation that we will be adopting. R is the risk-free rate of interest continuously compounded. We'll need that to discount the future cash flows back to the present. Delta T is this time that elapses between time steps. So let's say if T0 and T1 are a month apart, then delta T would be 1 out of 12 or 1/12 of a year. Now, here, this is something Hull introduced, and I think it's a good idea. Rather than using C for call and P for put, we're just going to use F for both of them. Why are we doing this? Because there's already P's floating around that mean other things. So Hull must have decided that let's just have some other letter that could be appropriate in both cases. So I'm sticking with his notation. F will mean the current option price. Now, when the option goes up, we're going to move to a new variable or value, which is called F, and then that U is a subscript. It means we went up because the stock went up, right? In other words, the option price follows the stock price. If the stock price goes down, the option value drops to FD. Okay, so the little subscript tells me if the stock price went up or down. Now, this is where it gets interesting. The stock tree. I'm going to show you a stock and an option tree for 2 time steps. The rest are just generalizations of this. Okay, so in the case of the stock, remember we introduced U and D. At time t equals 0, the stock is at S. If it goes up, it moves up to U times S. So be careful with that. This one is a subscript, F subscript U. It's some constant that we don't know yet. This is different. We're actually multiplying U by S to get to this new value. Down here, we're multiplying by D. Now, if you notice, we've got a second time step. So if we go up a second time, we're going to reach U squared S. If we go down from US, we'll reach DUS. And if we go down twice in a row, we find ourselves at D squared S. That is our 2-period stock tree. Now, in the bottom here, we have the tree for a call. And you can see the letters. Now, by the way, if you notice when we go to the second time step, we have FUU, FUD, and FDD. Again, the subscripts are there just to tell us how we got to that point. Now, here we're assuming that this is a 2-period model. The option matures at time t equals 2. So at time t equals 2, the option's value equals its own payoff. Now, remember the payoff to a call is max S minus K and 0. So what we're doing here is we're replacing the stock price with the values on this tree on the top. So in other words, if we reach FUU, that means the payoff is U squared S minus K and 0. Okay, FUD means it's the maximum of DUS minus K and 0. And then finally, FDD, it's the max of D squared S minus K and 0. Where we will fill in the exact numerical values, by the way. Right here, you're just seeing how the tree is structured. we will figure out the actual numbers. And then we'll fill them in, or we'll let Excel do it. All right, so this is your classic 2-period option pricing model with this Cox, Russ, and Rubenstein framework. Now, I do want to mention here that at least in Cox, Russ, and Rubenstein, U and D are considered to be inverses of each other. And so what that means is that DUS is the same as S. Okay, in other words, if you go up and then down, or down and then up, you're just going right back to where you started from. Whatever S was originally, we're right back where we started from. If we go up and then down, or down and then up. Okay, the tree is structured so that the sequence that you follow to get to a node is actually not important. What matters is how many ups and downs did you take along the way. Now, there do exist more complicated models where the path that you follow does matter, but not here. The paths are independent of each other. So up, down, up, it means the same thing. It's like going from left and then right, the same amount. You're right back where you started from. Now, for the put, the only thing that's changed is the payoffs. Instead of, for example, at FUU, instead of the max of U squared S minus K and 0, it's K minus U squared S and 0. So in other words, to get to the put price, the trees are the same. What's different is the payoffs. All right, so that's the only real difference. Now, what I'm going to try to do here is I'm going to try to skip over a lot of the theoretical discussion here. What we still are missing here, the only thing that's missing right now, well, two things. Number one, we need a formula for U and D. But we also need a formula for the probabilities of going up and down through the tree. So because we don't have all the time in the world, and because this is very complex, what I'd like you to do, what I'd like to do is show you the formulas directly. And then maybe later on we'll back up and see why these formulas are correct. Okay. But yeah, there's a lot of theory here. I think I'll summarize them for you. Maybe on a different document. Just so you have it somewhere. All right, here we go. So this is our friend, the Cox-Ross-Rubenstein model. CRR. And they're the first, but they're not the only ones. Okay, so we need to know a few things. First of all, U is defined as okay, so sigma is the volatility. And delta T is the time between steps on the tree. So in other words, if the model shows us monthly movements, then delta t would represent 1 month or 1/12 of the year. Okay, so now D is simply the inverse of that. So that implies that U equals 1/D, which in turn implies that UD equals 1. Okay. So any pattern let's see, how can we put this? The value of an option on any node of this tree depends only on the location of the node, not the path that was followed to get to that node. In other words, up, down, up, it means the same thing. Or it's like, imagine you're playing roulette. Does it matter if you got a red followed by a black or a black followed by a red? It does not. Okay. Now, as far as the probabilities are concerned, the probabilities on the binomial tree are, so the first one, we're gonna, oh, by the way, I'll tell you, I'll give you another document here for this. This is going to take a little bit of explanation. In option pricing theory, we will use what are called risk neutral probabilities rather than real world probabilities for the binomial option pricing model. And all the others too, by the way. Now, what is this all about? Well, in economics, we define 3 different types of risk preferences. You can be risk averse, and that is an investor who requires compensation for holding a risky asset. Which makes sense. I mean, it means that if I want to buy a corporate bond, I'd better get a higher return promised to me than for buying a treasury bond. We also have the concept of risk neutrality. Risk neutral means an investor who is indifferent to risk and therefore does not require compensation for holding a risky asset. To this investor, the returns to all assets, the investor would accept the risk-free rate of return to hold any asset in the economy. And then we have risk-seeking. An investor who values risk and would accept a return less than the risk-free rate in order to hold a risky asset. Because to them, the thrill of the gamble is so exciting that they actually would take less money. So what's happening here in option pricing theory, it turns out that the probabilities that we use to obtain our results are irrelevant. In other words, the price of an option is the same regardless of investor risk preferences. Now, that certainly is not true in the stock market or the bond markets. But here we can prove that the prices that we obtain are independent of the probabilities of the stock price going up and down. So because of that, the easiest assumption to make is that all investors are risk neutral. Now, the beauty of this is that all cash flows, all future cash flows, can then be discounted at the risk-free rate of interest. It was not necessary to estimate risk-adjusted rates of interest, which is what you would have to do. If you assume risk aversion, you have to estimate how risk-averse investors are and use an appropriate adjustment to your interest rates. So they're basically saying we don't need these and make the assumption, or we can use any assumption we want about risk preferences. So therefore, why not pick the easiest one? And that would be risk neutrality. So risk neutral probabilities then are the ones are those that are consistent with an expected return equal to the risk-free rate. Okay, so finally, what I'm going to show you is how they're calculated. Now, we're not going to go over how they were derived. That would take all night, and you might not appreciate it because it's very, very complicated, and it won't help you gain any further insights into what we're doing. It's a lot of theory. So instead, I'm just going to tell you. P is the risk neutral probability of an upward movement on the tree. If you want to read the slides, there is a discussion there about how these are derived, but I'm just going to show them to you. Okay, so we've seen, U and D, the upward and downward movement, R is the risk-free rate of interest. That would be found, hold on one second. Oh God, I lost it. I had it there for a second. Yeah, I'm flipping through the derivation. Ah, here it is. Ah, Jesus. Hold on here. No. Oh, here we go. So that's where they're going to come from. Those two formulas we had earlier for the the Cox-Ross and Rubenstein model, the upward and downward movements, and either are delta t. Now, if you look at the definitions carefully, you'll see that they do satisfy all the correct properties of probabilities. They add up to 1, and each one is between 0 and 1. So those are the probabilities we're going to use in our trees. Okay, so notice P means the probability of going up. 1 minus P is the probability of going down, but only the risk neutral probability. The actual probability is actually irrelevant. So all probabilities in these option pricing models are actually risk neutral probabilities, because to use something else would be much more complicated and there'd be no benefit to it. So now we can grab these. I'll have to, when we're done, I'll save up all these documents that I've been working on, and I'll make sure they get posted. And I'll call up NYU tomorrow and yell at them about Brightspace. But so now we can look at a graph and see what we're trying to do. Let's say it's time to price a European call. So here's, as we said, here's the stock price tree. Here's the option. Now, what's missing from this option pricing tree is what about times t equals 1 and t equals 0? Oh, that's the wrong one, sorry, this one. So in other words, we have the stock price tree. It's easy to fill it out because you're just multiplying each step by up or down. The option pricing tree, at maturity, we just set the option price equal to the payoff. But what about the interior nodes, as they're called? What are, for example, what are the values of FU and FD? Now that's where it gets challenging. So for that, we'll probably use another diagram. Also, I noticed that it's 8 o'clock, so I'll tell you what, this would be a perfect time to stop and catch our breaths a little bit, so that what I want to do is show you how you would fill in the rest of that tree. Okay. And then when that's done, I think we may be ready to jump into Excel. If you look at what I have here, I've got all these wonderful examples where I set it up so you can actually visualize what it's doing. Ooh, that should be helpful. Now, none of the assignments require you to do the binomial option pricing model. It's just too much too soon, but at least you can gain some insights into it. And so what we'll do is I'll draw the pictures and then we'll look at this example and take it from there. Okay. So, yes, Larry.
Yeah, sorry, just before break, I have a quick question.
Sure, go ahead.
What is the goal of the tree? Is it as the stock price moves up or down, you're just recalculating the option price? Is that all you're trying
Yes,
to do?
that's what you're doing. Exactly. We
Okay.
recalculate it. And when we're done, of course, we can't ignore the time value of money. We have to figure out the present value of all the future cash flows, and we'll consolidate that into a single number, which will be the options price. So you'll see when we're done, we'll have it all tied together, a nice, neat little package, and you'll say, ah, that is very interesting.
All right, thank you.
All right, you're welcome. So yeah, it looks terrifying, but when you see how it's done once or twice, you'll say, oh, that's not so bad. Okay, just it takes a while to get used to all this new notation. So anyway, so all right, we'll knock it off here for our usual 15 or 20 minutes, and when we get back, hopefully full of stimulation of some kind, caffeine or sugar or whatever, ice cream even, we'll carry on from here and we'll work some examples through to see how this is different than what Black-Scholes is doing. All right, I'll see you all in a bit. Oh, here we go. All right, so what I was gonna do is first draw a picture so we can follow the logic a bit. More easily, and then we'll look at the numbers. So let's just say we have a two-period model. Just to keep it simple. All right. Where am I? All right, so what we have to always do is first we have to create the stock tree. All right, so given the data that we have for this problem, stock tree comes first. We start with the current price of the stock, S, or actually in the slides, I think sometimes it's called S0 for the starting value. And then we go up or we go down. So this is today. This would be 1 year in the future or one period. It could be any length of time. It could be a week, a day, a month. It could be anything. Actually, I'm going to run out of space here. Hold on. Actually, I'm going to start it again. I can see that I'm leaving myself with not enough room here. Because we have to add a bunch of details. By the way, I also want to mention that U times S, S times U, it means the same thing because these are, this is multiplication. And the gap between these steps is assumed to be a constant, which we'll call delta T. Then we go up again. If we do, we reach U squared S. If we go down, we'll be at UDS or DUS. It means the same thing. If we go up from here, we're also reaching DUS. And then down here, we're at D squared S. And although you don't really need these, it's understood that these are the probabilities of actually going up and down these branches. So that's the stock price tree. Now the option tree is going to be based on this, but not maybe in the way you expect. Okay, so we'll start by just filling in the variable names. Actually, let me see if I can split the screen a bit. Just so you can follow along and see how the two evolve side by side. Yeah, there's not really enough room, but what we're going to do is this. We start with F. Now, F is the current price of the option. And here, remember, the notation is that this is F subscript U. This is F subscript D. We don't know what its value is just yet. And then if we go up again, we'll reach the node that's called FUU. Going down again can be thought of as FUD or FDU. And then finally going down again brings us to FDD. Now, since this is a two-period model, that means in this last time step, the option is worth its intrinsic value or payoff. So let's assume that this is a call. So here we have max. And remember, we're using K instead of X. The S, though, corresponds to whatever value the stock has at this node here. So in other words, after we go up twice, we reach U squared S. So I'm going to rewrite this as U squared S minus K and 0. Because that's what the stock is worth at that node. Okay, now similarly with this one, if I go up and then down, I'm at node DUS. Okay, so this one and then finally this one I could rewrite it as max D squared S minus K and 0. Okay, so this is pretty much as far as we got before. Now, here's where it gets interesting. What do we do about FU? Oh, and don't forget these P's are here. So basically the way we're going to treat this is each option price. Oh, one more thing. This is still European. I just want to remind everyone, we haven't gotten to the American versions just yet. Okay. So the FU, I'll explain it right here. The option prices at the interior nodes, they're called, are calculated as a weighted average I actually, discounted weighted average of the following two nodes. Okay, so in other words, FU, which I will split the screen again, will be calculated in the following way. So in other words, this part is the present value. I'm taking the present value of what happens one time step in the future. That's why this needs to be here, because these cash flows occur in the next time step. What you have here is what we call a weighted average of the following two nodes, the two that we can reach from here, that is, where the probabilities are the weights. So basically, from the perspective of node FU, on average, the value of my option should be what's inside the brackets. But then I have to discount that value back to today because this occurs one period in the future. Well, that being the case, the others will be done in the exact same way. In other words, FUD, or FD rather, I'll put it down here, will be obtained as the present value of the nodes that we can reach from FD. Okay, we can go up to FUD with probability P, or we can go down to FDD with probability 1 minus P. So those are these two. And then F itself, from F, we can reach FU and FD. So therefore, the final value that we need is F. And based on the same logic, it'll simply be PFU plus 1 minus P FD. And that's it, we're done. So we go to the end of the terminal date of this option. We calculate the intrinsic value or the payoff, and then we populate the interior nodes in exactly the same way. Every one of them is the present value of the weighted average of the two nodes that follow. And that's what we do. We fill in the tree with all these results. And F itself is the price of the option that we're looking for. So that's all that it is. Yes, Larry.
Yeah, I just have a question.
Sure.
Does this include or not include volatility? I mean, when you're going up and down these branches or nodes,
Yes.
What is it that you're really trying to do with this?
Oh, well, the volatility is captured in the U and the D parameters. So in other words, if the vol goes up, the spread between them would be wider. Like, let's say, for example, this one is 50, 40, and 30. If the volatility goes up, you might have instead 60, 30, and 10 or something like that. So the volatility is being captured by U and D. And so,
are you saying that by using this formula, you can capture the next node based on the movements of the previous nodes. Is that what it's trying to accomplish?
Right, it's saying that, based on our assumption that the, stock is following the normal distribution, what we're actually doing here is creating the so-called binomial distribution. But it turns out that with the binomial distribution, if we have enough time steps, it starts to converge to the normal distribution, which is what Black and Scholes are assuming. So at this point in time, right now, with the volatility being what it is, this is the tree that will reflect the correct option price. If the vol goes up, we have to recalculate the whole thing. And then what will happen is the branches will get further apart, and then that would increase the price of the option. Because
is it saying like in the long term, there's some sort of predictability with the?
No, nothing to do with predictions. This is like what's going on now in the marketplace right this minute. What is the correct price of this option based on the data we have right this minute?
Okay.
Now, if tomorrow we reprice this option and the vol is going up, it would be reflected in the stock tree because you would have different values for U and D. The spread would be greater between the branches, and that would in turn affect the values of these, which, by the way, a large percentage of these nodes will end up with a zero, okay? Because like, especially the bottom branch, these tend to finish out of the money. So when you fill one of these in, you'll see, in fact, if you look at our spreadsheet, let's try this one. Oh, this one only has 2 steps, so it's hard to see, but even here we have a 0 on the bottom branch. In fact, I'll tell you what, this one only has 1 time step. Maybe we should take a look at it. If you assume that this is the tree, okay, U is 105, D is 0.95, it's only 1 time step. If the strike of this option is 100, in this this is the upper mode, or node, I should say, the intrinsic value or payoff would be 5. Down here, the option finishes out of the money. This is a call. Over here, you can see that the tree evolved as follows. Now, where did this number come from? Well, over here, if you notice, I calculated the risk neutral probabilities, and here I have the discount rate. So this F right here is what we use to come up with this 3.90384. And what you've got, although I guess I could handwrite in some of the details. The time step is 1 for 1 year. The probability is 0.80455. That's the probability of going up to a $5. That's FU, and this is FD. So there's an 80.455% chance of reaching a $5 payoff. And similarly, there's a 0.195 chance of going to 0. So if you plug those into your calculator, you'll see that you do actually get approximately $3.90. So that's what is going on there with this very simple model. Now, on the bottom, I've got the equivalent trees for the put. The only thing that changes is right here, the payoffs. So if you scroll down, instead of SU minus K, it's K minus SU, and the same thing here. So instead, if you notice what's happening, on the upper node, we have a payoff of 0, the option finishes out of the money. Down here, we have $5, the option finishes in the money by $5. It's based on the same stock tree, of course. And now when you plug in these numbers, you'll end up with about 95 cents. So because actually this one is right at the money, if you notice. The strike is 100, the stock is 100. The call usually, all other things being equal, calls tend to be more expensive than puts. And that's you can see that here too. It's $3.90 for the call versus about 95 cents for the put, even though they're both, it's right at the money. Okay, so normally this is what you'd expect. Let's see, what's on 2 here? This is a 2-step tree. And you can see I've already filled it in for you. But it's nice to know where these numbers came from. So this is our 2-step tree, and you've got, here's the tree, the stock tree, which has already been done for you. And it's the same thing. It's just U time, this is U squared S, this is UDS, this is D squared S. So that takes care of this tree. Over here for the call, we have the intrinsic values or payoffs based on these 3 stock prices. So with a strike of 100, this option or this payoff is 12.455. Here it's 1.745, and here the option finishes out of the money. And then these two are calculated in the exact way I just showed you. It's the present value of the weighted average of these two. Here's the present value of the weighted averages of these two. And then finally, this one is looking ahead at these 2 nodes, and we come up with approximately $8.11. Down here, all I had to change was the payoffs, because this is a put, and the rest of these interior nodes are calculated the same way. And instead of 8.10, I've got about 42 cents. But now this is different because here the call is $2 in the money. The put is $2 out of the money. That's why the price difference is so great. Now, in principle, you could extend this out as far as you want. You could have 3 time steps, 20, 50, it doesn't make any difference. Normally, you would like to have as many as you can, because that should improve the accuracy. Now, how do we adjust this for American options, which is really kind of the whole point of this model? That's a good question. What we have to do, the payoffs are exactly the same. What's different with the American options is that for all the interior nodes, you have to make a decision. Does it or does it not make sense to exercise this option early? So, okay, so we have this. Yeah, so there's more examples in here you can see. But what I'm looking for is the American options. Yeah, and a lot of the ones in this spreadsheet are actually just taken straight out of these slides. So here I'm extending it to multiple periods. We've already seen that. Let me see if I can find the American options. What would change? Oh my God, there's so many examples. This is good if you want to read through these. This is the difference. So far everything looks the same, doesn't it? Yes, it does. Where is it different? Well, with the interior nodes, let's say this is, just to keep it as simple as humanly possible, this is a 1, or actually no, what I've done here is I've just shown this part of the tree, just the FU part, where it goes up to FUU or down to FUD. If this is an American option, what we have to do is decide, does it pay for us to exercise it early? Now, if this is a European option, the value at FU is right here. We've already seen this. It's simply the present value of the expected payoffs. If we exercise early, though, we'll get the payoff of the option at that node. And since this is the node that we get to after going up once, the payoff would be SU minus K, max SU minus K or 0. So what we're basically being asked to do is say, listen, which one of these 2 numbers is greater? This is the payoff to the American option. If it's exercised, this is the value if not exercised. In other words, it's the same value as if it were a European option. So only if the payoff exceeds this value on top do we exercise the option. And if we do, that's the number we put on the node. If not, we use the European value on the node. So every one of those interior nodes requires us to compare the European value versus the payoff or American value. Okay, the higher the two is what we put on that node. So I think, let's see, where did I put those examples? Now, the only problem with making up these examples is you can actually, if you don't have enough time steps, you may have a case where it never gets exercised, the American option, and that does make it a little trickier to see what you're doing. Oh, we can turn this off. Let's see, what do we have here? Maybe the, I don't know, let's look in the slides. Yeah, it looks like that one, it never got exercised. Let's see, this is an American put. Oh, this is terrible. I didn't find an example where it made sense to exercise it early. Oh, this is terrible. Oh, wait a minute. Let's see. Let's look at this example one more time. So this is a new example. We have a 2-year American call with a strike of 100, and it's currently selling for 110. We have the following details. And so we populate the tree. And remember, the strike is 100. So we don't have to worry about these. We know that the option will sell for its intrinsic value here. We need to look at the up node, the down node, and the initial node. So for FU, this is the payoff if exercised early. And this is the value if not exercised. So at least at this node, it doesn't make any sense to exercise it early. So that will be the value we put on the tree. Oh, wait, it's down here. Okay, so this one is not exercised. For FD, oh, okay, this is the payoff if it's exercised. This is the value if not exercised. Okay, so that means obviously this is the value we'll leave on the tree, and this is the value that we will collect. We will have because we did not choose to exercise it. So here, this one is not exercised. But what about the current one? Let's find out. Now, in this case, same thing. Well, I guess that means this one was never exercised. But let's say that it was. What would be different? Okay. Let's say, for example, let's say that for whatever reason up here, exercising early would have led to a payoff of 25. Then you would replace this 25 here. Okay, that becomes the value. And then that will raise the value of this node. Okay, because you're looking at these two. So let's say if that was the case, which it wasn't, unfortunately, this is how it would have manifested itself. You would have put the payoff here with the understanding that you did exercise it, and then down here you don't. But now this number would have to go up to reflect the fact that you do have the higher payoff here. Okay. So I didn't realize that I don't seem to have any examples here where we do exercise early. But if we did, then you're supposed to assume that you would exercise it and collect your payoff. Okay, that's how the model works. You always assume that you'll exercise early. If it gives you a better payoff, then just hang on to it. So that's how they're different. Yes, Larry.
Yeah, when I was looking at this, the question I kept asking myself is, well, how would you actually know? So I understand that a certain node, maybe the payoff is the right one where you might exercise early, but you don't really know the next week or so what could happen. Couldn't that situation change?
No, that's right. You don't. If now, by the way, in the real world, if that was the case, what you might be tempted to do is not exercise it, but to sell it to somebody else. That's always on the table. But as far as the value of the option itself is concerned, we're assuming here that you will always exercise early when it makes sense. So even though you know something might change next week, it might not. You see, you don't know. And the earlier you collect the money, the more sooner you can reinvest it. So, in the real world, you might say, well, I know that it technically makes sense here, but I'm going to hang on to it a little longer anyway. But here, this framework tells us that we'll always exercise early if we can. And that's where the numbers are coming from. Whether that's realistic or not is, true, but that's how the framework is done.
Is that maybe just a rule of thumb for maybe a money manager that there are acceptable times to exercise or sell your option, and then there aren't acceptable times based on that model?
Yeah, like I said, like if you need to raise money, but you don't think it makes sense to exercise early, you always have the option of selling it to somebody else. And then you will actually, the drawback to exercising the option early is that you're losing all the time value. When you sell it to somebody else, you actually get to keep the time value because that's part of the price. So that's why a lot of these options are never actually exercised early, even though you can. This right conditions may not ever be reached. And in fact, there is a formal theorem that shows that if your option is written on let's say, non-dividend paying stock, then the American call will never be exercised early because you're always going to lose more time value by exercising it early than you'll gain in the interest that you could earn with the proceeds. So, but with puts, there's always a chance you might exercise it early. But it depends. It depends on how deeply in the money your option is compared to the remaining time value. So what it really means is that, well, having an American option gives you more flexibility, but it doesn't necessarily mean you're ever going to exercise it early. But it's good to know that you have that right in case you need it. Also, if you notice, we're assuming that you'll never exercise it when you shouldn't. Okay, in these models, we're assuming that everybody knows what they're doing and they'll never do something that makes them worse off. Okay, now, is that a good assumption? Maybe not, but that's the assumption that we're going to make. Okay, so that we can all agree that the binomial option pricing model gives us this number because we're assuming that everybody will hold off on exercising until it makes sense. But anyway, let me look at this spreadsheet just in the off chance. I think that's all of our examples. Oh, wait a minute. I think that in sheet 4, there is an example where this yellow tells me that it was exercised early. All right, here we go. We have an example. So with this case, we filled in the tree. This is the tree. And okay, so here's what happened. We have the intrinsic values here, the payoffs, fine. Here we calculated the European value. In other words, what would it be worth if we're not allowed to exercise it early? And then here, $5 is the payoff to exercise. Remember, the strike is 100. So the fact that I yellowed it in means that this is one case where we actually did exercise it early, because let's see if we can figure out quickly what the value would have been had we not exercised it early. That would have been equals, let's see. The present value term is right here, B7. Okay, equals B7. The hell is wrong with this thing? Times, okay, so we'd have the probability of an upward movement times the value we would get by going up, which is here. All right, now I've completely messed it up. Hold on one second. All right, let's try that again. If I'm at this node, going up brings me to 25 cents. So the probability of doing that is here times the value of 25 cents plus going down brings me here, and that probability is here. And all of that is now multiplied by the discount factor. And so this is going to tell me what the option would have been worth at that node if I did not exercise it early. Okay, what the hell is wrong with it? Why is it doing this? It's giving me all these weird messages. B7. Oh, you know what I did? I missed one of the parentheses. Okay, there you go. Perfect. So there's at this node, it would have been, if this was a European option, at that node, the option would have been worth 2.04453. But here, if I exercise early, I get a $5 payoff. So I go ahead and exercise early and I get that payoff. And now this number is higher than it would have been had I not exercised it early. It's 98 cents. Now here I did not exercise it early. I can tell because it's not yellow, but I would have compared this. In fact, it would not make any sense because the strike is 100. And at this point on the tree, the price is 100. So exercising early would make no sense because that would give you a payoff of 0. So instead, this would be the result of doing all of this. Okay. So anyway, so we did finally find an example. This yellow was there to remind me that here we exercised it early. So finally we got an example, which is kind of nice. All right. So anyway, I think we have everything. So what I did was I kind of glossed over a lot of the theoretical results. Like the slides explain to you why the risk neutral probabilities have those formulas. But I would say maybe that's not the most important thing right now, unless you really want to read through it. It's kind of involved. So it's there if you want it. But remember, those risk neutral probabilities refer to a risk neutral world where we're all satisfied with earning the risk-free rate of return from our investments. And this is what we use in option pricing models because the choice of probability does not actually affect the final result. That's because we can replicate, by the way, the reason why that's true is because we can replicate the price of an option with the price of other securities in such a way that the results are risk-free. So, but anyway, it's almost 9 o'clock. So I guess we better stop here. So the assignment, like I said, does not require any binomial option pricing modeling. Just do the Black-Scholes with the template here, and you'll be all set. Just save it with a new name and change the numbers, and that's all you need. And then you can fill in the short fill-in questions. And that's all you really need to do. So you should be fine in spite of the complexity here. Now, next time we're going to be looking at the risk measures, which are known as the Greeks, which help us understand how sensitive the option prices are to changes in underlying variables like the volatility and the time and the stock price and all the rest. And that will lead us up to a discussion about risk management and how options are used for risk management purposes. Okay, so I guess that was pretty terrifying, but it could have been worse. I think we did it right here. And so what I'm going to do is save all those documents that I've been working on, these extra documents, so that we don't lose them, and I'll post them on Brightspace. And I'll call the school again tomorrow and see what's going on with that nonsense with the spreadsheets, because it's really irritating. There's no reason why that should happen. In fact, when I talked to the guy on the phone, he's like, "What do you mean? I've never heard of such a thing." So lucky me, I'm the one who gets to be the guinea pig for this. All right, anyway, so there's no last minute questions. I guess I'll see you all next week then.
Thank you.
Okay,
Thanks.
good night.
Thank you.
Okay, bye.
Thanks. Have a good night.
Okay, good night.